If YouTube was a high school party, then Vanguard would be the cool kid in the corner that everyone is clambering to be friends with. You know the one I mean. They're good looking, they're sporty, and they get all the good grades too. Yeah, it makes you sick, right? Not that I'm bitter, of course. Well, Vanguard are one of the most popular investment platforms, and one of their flagship offerings are the LifeStrategy funds. So in today's video, we are going to take a look at all of this right from the ground up. Now I know, like the cool kid at the party, your time is important, so please use these timestamps. There's a lot to get through. Let's get on with it. My name is Tom Morgan, I'm a financial advisor and planner based here in the UK. First things first, remember nothing in this video can be construed as advice. If you need advice, go and seek advice tailored to your circumstances. Let's start with who are Vanguard? Well, unlike this whippersnapper, they've been around since 1975. They opened their UK office in 2009. Interestingly, they have no external shareholders, so profits, they say, are redistributed for the benefit of investors. What does that mean? Well, essentially it means that you'll probably find them to be cheaper than most. They were founded by Jack Bogle, who is famous for saying, "Don't find the needle in the haystack, just buy the haystack instead." And that actually made him a pretty unpopular man with his Wall Street counterparts. And with Jack Bogle, the index fund was born. So first things first, what is a fund? Well, your money is pooled, collected together with the money of other investors to create a big old pot of money that can be invested in lots of different types of assets, and it's all an attempt to try and increase your diversification and spread your risk. Imagine everyone at that party chucking a tenner in the hat to go and get more booze. Now the assets that the fund will buy will depend on what type of fund it is and what they're trying to achieve, and they will buy different assets in different proportions. Now the two main types of asset that you need to be aware of for this video are equities, or stocks and shares as they're sometimes called, and bonds. It's a bit like having some booze and some soft drinks. Each have their distinct advantages and disadvantages. So now let's take a look at what is the difference between equities and bonds. Right, if equities and bonds were long-distant cousins, then the edgy cool one would be equities, or stocks and shares. This is money that's invested in a company by buying shares on the stock market and are usually traded on something called a stock exchange. You're essentially buying a little piece of a company, albeit in most cases a very small one, and what you're hoping is, as the company does well and the share price goes up, you make money with them. Also, sometimes companies will distribute some of their profits as something called dividends, although not all shares do that. Now, the other cousin is the more predictable one, the safer one. It's the one that's less likely to be jumping out of windows the morning after. Bonds. A bond is a loan from the buyer, you, to whoever is issuing the bond, and in return they will pay you a fixed rate of interest for a specified term, a piece of time, where at the end you would get your money back. People that issue these bonds range from governments to companies, and the risk involved is pretty heavily tied to whoever it is you're lending the money to, how secure they are. Now, the most secure type of bonds tend to be government bonds, because it's very unlikely that the government aren't going to pay you back. But as such, you will receive a lower rate of interest because the risk is lower. Higher risk bonds can be to companies where the risk of default, i.e. the risk of them not paying you back, might be a bit higher, and as such, you will likely get a higher interest in return. Now, funds can invest in a combination of these assets, and how they tend to be constructed often comes down to whether they are actively managed or passively managed. So let's take a look at what that means next. Active investing is when a fund manager takes a hands-on approach in an attempt to try and beat the average return of the stock market, essentially by buying and selling at the right times. It involves more people and more research, and essentially you're putting your trust in the fund manager and their team that they can use their expertise to your advantage. Now, of course, no one has a crystal ball, so they can't possibly know what's going to happen with their investments. But what you're relying on is them being right more times than they're wrong. Due to how this kind of investing works, they are more expensive to run, and that will be passed on to you as the investor. You will pay more in fees for this kind of service. Now, passive investing is very, very different. It's more of a long-term hold strategy. You're not trying to anticipate and react to every little movement in the stock market. As a result, there tends to be less buying and selling, and it is a much cheaper way to invest. Now, the most common way of passively investing is through something called an index fund, which none other than Jack Bogle himself came up with many years ago, and it has become a stable and norm for many, many investors ever since. So let's have a look. What is an index fund? Now, hopefully you have an understanding now on what a fund is, but in order to understand what an index fund is, you need to understand what an index is. An index is just a list. It really is that simple. What is in the list depends on what index you're looking at. There are thousands of different indexes that track the ups and downs of different stock markets across the globe and different sectors too. For example, you've probably heard of the FTSE 100. That is an index. It is simply a list of the 100 largest companies listed in the UK. And you've probably heard of the S&P 500. Again, that's an index. It's simply a list of the 500 largest companies based in the US. There are more specific indexes too that track specific sectors. For example, there's one called the US Global Jets Index that tracks specifically the global airline market. Now, you can't invest directly in an index. It's not really a thing. It's just a concept. It's a list of companies on a fancy spreadsheet, if you like. However, you can invest in an index fund. And in fact, what most index funds simply do is copy the index by buying and holding the assets that are in that particular list. If you buy into a FTSE 100 fund, you are essentially going to buy in a little piece of the 100 largest companies in the UK, just like what the FTSE 100 is. And so investing in that index funds mean you actually invest into the 100 largest companies in the UK, and how your investment performs will be linked to the ups and downs of those 100 companies as a group. This is what Jack Bogle meant when he said, don't try and find a needle in a haystack, just buy the haystack instead. Now, there is a point to giving you all this background. Look here on the Vanguard website. Look at all these lists of available funds that you can choose to invest from. Confusing, right? So for many people that don't want to build their own investment portfolio or simply find all these options just overwhelming, that for me is where the LifeStrategy funds come in. So what are the Vanguard LifeStrategy funds? They are passively managed blended funds. Funds inside of funds. I know, right? Let me explain. The Vanguard website says, invest globally without the bother of managing a portfolio yourself. Just choose your blend and leave the rest to us. Now, there are 5 options to choose from. There is the LifeStrategy 20% equity fund, the LifeStrategy 40% equity fund, 60%, 80% and 100% equity fund. And each one of these LifeStrategy funds simply invests in a selection of those funds that you saw in that big old list earlier. You invest in one LifeStrategy fund and your money will be split across a selection of different funds as chosen by the Vanguard committee. And as the name suggests, each different fund contains a different percentage, a different proportion of equities and bonds. The higher the equity content, the higher the level of risk, and also the higher potential rewards that you might get. So the reason that there are 5 different funds are to cater for different levels of risk that you and I might like to take as investors. Interestingly, the most popular LifeStrategy fund, if you look at how much money is in each fund, is actually the LifeStrategy 60% equity fund with £9.8 billion invested. Now let's jump into the LifeStrategy 60% equity fund. And if we go down onto portfolio data, what you will actually see is a list of all the funds that are included in the LifeStrategy 60% equity fund. So by investing in this one fund, you actually invest in 18 different funds that Vanguard offer. And each one of those underlying funds will be holding a whole host of different equities and bonds. So what that really means is that by investing in one LifeStrategy fund, your money will be invested and will be holding somewhere between 6,000 and 20,000 different equities and bonds spread across the world, all in an attempt to lower your overall risk. Each one of these LifeStrategy funds are automatically rebalanced. So what that means is that Vanguard monitor and make sure that the split between equities and bonds stays the same at all times. You see, what happens is this. Let's say that you'd invested £10,000 in the LifeStrategy 60% equity fund. You'd have 60% in equities and 40% in bonds. So 6,000 in equities and £4,000 in bonds. Now, typically what tends to happen is over the long term, equities tend to outperform bonds. So let's assume for this example that the equities in your portfolio grow by 8%, but the bonds only grow by 3%. The £6,000 you had in equities would now be worth £6,480, an 8% increase, and the bond portion would be worth £4,120, a 3% increase. Your whole investment is now worth £10,600, but look what's happened to the overall balance. Out of your £10,600 investment, around 65% is now in equities and 35% in bonds, which is not what you signed up for. So in order to restore the balance, some equities are going to need to be sold and some bonds bought, and Vanguard do this automatically for you. And the reason they do this is to make sure that the risk you are taking is maintained and you are getting exactly what you signed up for at all times. But how have they performed? Now remember, past performance is not a guide to future performance, but it is always interesting to take a look. Let's focus on the LifeStrategy 60% fund again. So here we are looking at the annual performance back to April 2016. The best results were actually in the last 12-month period look with a 21.46% return, and the worst result was the year previous, which showed a negative return of 3.57%. But what I find is perhaps a more meaningful way of looking at performance is looking at the cumulative return, which essentially is what is the journey that your money would have gone on if you'd have invested from the start of that period. Now the cumulative 5-year return for this fund is 51.89%, and what that really means, look, is if you'd invested £10,000 at the beginning in March 2016 and watched your money go on the journey for that 5-year period, you would have £15,188.55 at the end of March 21. Now that's a lot more than you would have got if you left it in the bank. So hopefully that helps you understand these investments a little bit more, but what are, in my humble opinion, the pros and cons? First, let's start with the pros. Charges. They're cheap. Costs eat into returns, so keeping them as low as possible is always a good thing. The Vanguard platform only costs 0.15% a year, and each one of those LifeStrategy funds costs 0.22% a year. They're all the same. Or in other words, for every £1,000 that you invest, you're only paying £3.70 a year in fees. Or the way that I prefer to look at it, if you had a 5% return, you'd get to keep 4.63% of that return, and trust me, that's cheap. Now they are rebalanced automatically, which means you don't have to worry about it. This fixed allocation rebalancing method essentially means that when equities go up, you will naturally be selling some of those, taking some of those profits and buying yourself some bonds. But what it also means is that when equities fall in value, some of your bond holdings will need to be sold to buy more equities to keep the percentage balance in check. If you're a fan of buying the dip, as we keep hearing all over YouTube, then this is going to be music to your ears, because essentially you're going to be buying more equities while they are on sale. The people that favour this approach tend to be braver investors that aren't quite as concerned with volatility. If you weren't using the LifeStrategy funds and you simply bought yourself some equity funds and some bond funds, and therefore it was up to you to keep the rebalance percentage in check, more than likely you simply would never get round to it, and what happens over time is that your portfolio tends to get riskier and riskier as time goes on if you don't rebalance. Another pro is that Vanguard, the platform itself, offers a variety of tax wrappers. There is a personal pension, a stocks and shares ISA, a junior ISA, and a general investment account, which is all good news because it means if you're choosing to invest in these life strategy funds, you can do it in the most tax efficient way possible. And finally, they are very well diversified. Putting your money into these life strategy funds will see your money be spread across different assets in different geographies, all in order to reduce your overall risk. So, what are the cons? Well, the first con is that on the Vanguard platform, you only have access to Vanguard's own funds. There is a much bigger, wider world out there full of other interesting funds and interesting investment opportunities which you will not have access to via Vanguard, and I don't see that changing in the future. So if you're looking for more range and options outside of Vanguard, then the Vanguard platform is probably not the place for you. Also, if you're looking for something more tailored to you, you won't find that with the life strategy funds. They're a one size fits all, or a five size fits all. If, for example, you wanted a higher percentage of your portfolio in smaller US companies, the life strategy funds are never going to achieve that. Index funds are weighted by market cap. What the hell does that mean? All it means is that the larger companies tend to make up a larger portion of the list, the index. So when you're index fund investing, you tend to have a larger allocation to larger firms. Now, interestingly, although I included the automatic rebalancing as a pro, I am also including it as a con, and here's why. Not everybody likes the simple computer-based automatic rebalancing that simply happens. If you're a fan of more actively managed investments, what they have the ability to do is go overweight and underweight in different areas where they see trends and things that they like the look of, where they think returns will be better. Whether it's worth the extra cost and how consistently they deliver results, I mean, ultimately you are betting that the fund manager gets it right more often than they get it wrong. So it's really a personal preference and your call on that, but just be aware of how the rebalancing works to make sure it fits with how you want your portfolio to be run. Now, there are a lot of people that grumble, including me, about something called home bias in these life strategy funds. Let me explain. If we look at the 100% life strategy equity fund here, and if we go into the portfolio data tab so that we can see what funds are included in this 100% equity fund, what you'll notice is this. We've got 19.4% in the FTSE All Share, 4.7% in the FTSE 100, and 0.9% in the FTSE 250. So a total of about 25%, a quarter of the portfolio, is invested in some way in UK companies. Now, if you were to compare that to a global index tracker like Vanguard's own Global All Cap Index Fund, which only has around 4% in the UK, you can see that the life strategy funds have a lot more in the home country here. Now, if you compare the UK market to, say, the US market, you'll find that the US market has pretty consistently outperformed the UK. So this percentage, or this heavy percentage to the UK, is not going to be to everybody's taste. Having more assets in your home country certainly hedges against the currency risk, and I imagine that's part of the Vanguard strategy, but I might not favour those percentages at the moment. One final small thing to mention on the cons is that there are minimum investments in this fund of, if you're making a single investment, it's £500, a regular investment £100. A bit unfair really to include it as a con, as I think they are pretty low barriers to entry, so most people serious about investing will be able to do that, but worth a mention nonetheless. So if you're still listening, first of all, thank you. You've really helped my average watch time. But let's see if we can answer the most important question of all. Now that you understand these investments and what they're about, are they, or could they be, the only investment you ever need? And the simple answer is yes, they really could be. They suit a lot more people, in my opinion, than they don't suit. And I think especially if you're a beginner, if you're brand new to investing, then I think they are really worth looking at as a place to start. Whew. There we are. Hope that was useful. Remember, we put a new video out every single week, so please subscribe. Look after yourself. See you next week.